Drilling fluids touch just about everything in the drilling process. We're here to deconstruct the drilling process and drilling fluid concepts to provide a deeper understanding of our industry. In each episode, we'll share information, talk to interesting people, and maybe share a few stories along the way. Welcome to the Flowline, a production of AES Drilling Fluids, brought to you by Matt Offenbacher and Justin Gauthier.
Well, welcome back to another episode of the Flowline. This is a special episode with a recurring guest. I guess you've been on a couple of times with us now, but Josh Young of Bison Interests. Josh is a great friend, but also another person who works in the oil and gas industry. And so, Josh, I was wondering if you could reintroduce yourself and tell us a little bit about what you do.
Sure. Yeah. So I'm Josh Young. I'm with Bison Interests. We invest in publicly traded oil and gas companies. We focus on upstream companies, which means oil and gas producers and drillers, but we'll also invest on occasion in oil field services companies and midstream companies and really any energy company across sort of the value chain. And we launched Bison in 2015.
Cool. I know that's probably one of the fun things. You know, we sort of have this group of friends that we run around with and get to talk about, make fun of each other's career choices and, talk about energy and where we think the whole world is going. And it's a good bit of fun. And that's really what this episode is going to be about. But first, one way to get Josh on the show, actually, he'd show up for any reason, but I wanted to feed him something good. So we had some barbecue from I don't know how to pronounce it. FEGE, Fies, maybe? Is that? I don't know.
I'm not sure.
Anyways, it was really good. But Josh, you're quite the connoisseur of grilled meats. And so I think to, get a little bit of our listeners engaged, tell us more about what you like to grill, how often you grill, because I think it's quite a lot. And maybe a little bit about how you share with the world what you're grilling.
Sure. Okay. Actually, I don't know that I've ever been asked this on any sort of interview, so maybe this will be very original. Okay. So I moved here to Houston in 2016, and actually I think we met right around when I moved here. And one of the things I found that was so interesting moving from LA to Houston, obviously the weather's a little worse, the beach is a little worse and a little further. The people are a lot nicer and the meat is a lot better. And there's this wonderful store called HEB, which has really high quality meat at actually really reasonable prices. And occasionally they have these just phenomenal sales where you get like ribeye for $4 a pound or something like that. So, that sort of inspired me. I am very value focused and I like to grill. I liked to grill even before I moved here. But I'd say at first I was grilling maybe 2 or 3 times a week and really just trying to figure out the whole thing. Cause the joke is that most people just, put meat on the fire and they sort of move it around to pretend like they know what they're doing. And so eventually over time, we sort of figured it out. And I think I'm down to grilling meat maybe like once or twice a week. Set up a Twitter account just dedicated towards grilled steaks and other sort of barbecue. I think on my sort of main social media, there were some people that were interested and there were many people that just wanted me to talk about oil and gas and geopolitics and that's it. And so, set up that separate Twitter account and, have a really engaged following of about 450 people.
Yeah. And it's barbecue time, right?
That's right.
The handle. Yeah, I think it's fun to follow, and it's also interesting kind of where you're at, because it's like, okay, that's his house, that's somebody else's house. Last night you were at some dive bar, like it's just, anyways, it's amusing to see what Josh has either had grilled for him or grilled for others. But we got a lot of, we have a lot of field personnel who listen. And one thing that you do to make everybody happy on the rig is grill up some steaks or whatever you can afford and give everybody a nice meal. So
yeah, so I guess just one. So you mentioned the bar. One of the other things about Houston that's so great, and it's very different from Los Angeles or most other places I've been to. There's a lot of bars here that have steak nights on different nights of the week. And one of the things I found, similar to on a rig, even here back in the city, people love getting together for barbecue. and they love getting together. I guess technically it's not barbecue if you're grilling steak over charcoal or whatever, but whatever. I figure it still counts. And so, last night I had dinner actually with, I think, at least one of your customers, and then, a couple other sort of senior oil and gas industry folks. And, it's sort of hard to get them all together, but it's like, hey, there's a steak night at a bar. And even there was one guy who was pretty busy and was like, oh, I probably can't come, told him what we were doing, and he showed up. So it's really good for sort of getting people together, and then also just sort of wildly affordable. Like, where can you go in the country to get a 16-ounce ribeye for $20 cooked for you perfectly?
We are in wonderful times in the midst of God's country. What can we say?
Absolutely.
Yeah. Well, so, I guess we'll start with just, do you have any like legal disclaimer, anything you're supposed to throw out there? Because we have a disclaimer at the beginning of our normal episodes, but we're going to talk a little bit about the state of the industry, and we want to keep you out of trouble. This is just for entertainment, but you've got your line, right?
Sure. Yeah. So none of this is financial advice. None of it's a solicitation. I do run an investment fund, and this is not a solicitation or recommendation or offering for that. Nor if I talk about any commodities or securities, people should do their own diligence. And if they're considering making an investment in anything, they should consult their financial advisor.
It's almost like you've had to say that a few times before.
Yeah.
So with that, where do you think we're at in oil and gas? We were just talking before this about how oil energy stocks are kind of, in bad shape. The rig count seems to keep dropping. I mean, what do you see as the state of the oil and gas market right now?
Well, it's so bad that they just killed the DPR report. So what that is the monthly shale productivity report that the EIA, the government agency tracking and providing statistics on the energy production and consumption in the U.S., they just killed this report that was really helpful in understanding what was happening in the industry and sort of what emerging trends are. And so I think it's sort of the perfect sort of microcosm for what's happening in the industry, because we're at this point where the narrative is, hey, if it's not AI, if it's not tech, sell it, short it, get out of it, don't own it. That's sort of the narrative. That's the market consensus. That's sort of where funds have been flowing, I guess, secondarily to private credit and a few other spots, but really like the NVIDIA to the moon, everything else collapsing pretty much. And so at the same time, you have these really sort of powerful undercurrents where demand is rising more than anyone would like to admit. The IEA just, sort of declared victory on their forecast, even though they've missed on demand every single forecast. I think they've missed 18 out of the last 20 forecasts for global demand. So they're maybe less of a forecaster and more of an advocate to try to argue for oil prices to be lower and consumption to be lower. And so when you look at the actual trends for the industry, you're seeing that well productivity per foot is actually falling, even though surface intensity per foot is rising. And so this is very exciting for oilfield services companies and potentially for investments in them, but also very promising, I think, for longer term higher oil and gas prices. And then just one last thing, there's been a number of different mergers and acquisitions, and there's this really powerful trend toward consolidation, which has been pushing the rig count down, I think, temporarily. And there's a debate going on in terms of, hey, M&A typically happens at either the top of the cycle or the bottom of the cycle. And so we're probably at one or the other. And so, that's the sort of bull-bear debate, but we're probably not mid-cycle. And so if you look around at what things looked like the last time there was a big merger and acquisition wave and the time before that and so on, this, I would argue, looks the most similar to the late 90s, early 2000s, which is, I think, very similar to what we're seeing in terms of tech stocks and in terms of hatred towards the industry and in terms of just very significant accretion and synergies in these deals. In many cases, I don't own the stocks of either of the companies, or it's a public company buying a private or so on. And you just look at a map and you say, oh, okay, there's like overlapping leasehold. There's clear synergies, both in terms of just being able to manage that field better and being able to drill longer laterals and, not having to make as many compromises from an operational perspective, being able to save money on many different aspects of the business. So that looks very promising. But the last time there were deals like that were sort of this obvious and that the market cared this little about was, I'd say, the late 90s, early 2000s.
Do you think that, look, we're always, it's kind of a field office. Everybody's speculating about who's going to buy who next and all that kind of thing. Do you think that wave is kind of on the tail end, or do you think there's probably still some more deals in the making? Did we run out of big companies to buy? What's your take on that?
Yeah, I mean, it's the tough question. It's just like hey, are we at the top or the bottom? When you look at the available assets that are sort of known, like considered desirable, we have way fewer of those today that are available for potential sale than we had 18 or 24 months ago. Radically fewer. Just focusing on the Permian, so West Texas and Southeast New Mexico, you have Endeavor gone. You have Meridev that just got bought. Literally within the last week or so of us having this conversation. There's a rumor that Double Eagle for sale, which is a giant sort of agglomeration, and they had sold their last multiple companies to various large Permian operators. Earthstone's gone, Callan's gone. So you go down that list, and a lot of the things that were available on the public side and the private side have been bought by larger entities. And it doesn't seem, the signaling from those larger entities is not we're done. It's we're buying.
Yeah.
They're open. It's like the Brazilian, we talked about steak and barbecue at the beginning of this, the Brazilian, steakhouses, the churrascarias where, you flip it green or red. And it seems like most of those buyers are still flipped green. They're not flipped red. Even this Matador deal. And again, any stock I mentioned, I may or may not own it. None of it's a recommendation. Please don't rely on any sort of specific shared for any sort of investment or so on. So Matador just bought Ameridev just using their credit facility. And then I think they just did, I saw they did a second lien or whatever, like bond placement at sub 8% interest. And so, they were able to literally just credit finance a $2 billion, $1.9 billion acquisition, and they're not that big of a company. And frankly, I think actually Matador might be in play now that they have done this acquisition. And that's one fewer deal to do, right? That's one fewer $2 billion deal.
Do you think, I guess, we speculate on these mergers and that sort of thing. We definitely do see the rig counts drop, but there's also, you see a few of these mergers happen and they say, we're going to sell some acreage to fund some of this. We're buying core assets. We're going to divest of other things. Do you think that's possibly cyclically an opportunity for new drill teams to start up and the private equity folks who've maybe been on the sidelines to say, okay, we're going to do something again?
So yes to half of that. So it's sort of similar early 2000s, late 90s, where the big oil major mergers led to divestments of onshore U.S. assets, which ended up making the NGPs and NCAPs and so on that were active at the time enormous amounts of money. They backed teams that went and bought those assets from oil majors. And they say one of the most sure ways to make money in oil and gas is to buy something from XYZ large oil major. I'll leave out their names, but there's a couple in particular that, they're more likely than not, if you're buying from them, you're going to make a lot of money. And those early energy private equity funds did extraordinarily well on those acquisitions. So in theory, they should be there for it. And for certain teams, they are there. The problem is that oil and gas is still hated. And even though some of the sort of the bleeding edge is sort of pulling back, let's say, from ESG and DEI and so on, the reality is that most of the allocators that have committed to divest from oil and gas are not coming back into the sector.
Sure.
It's just the few remaining ones that are continuing to invest. But even those, a lot of there are some real challenges in the fund management business and in the institutional investment business where because there were such large allocations by some endowments and pensions and foundations and sovereign wealth funds to private equity generally, not just oil and gas, and because credit spreads blew out, actually the spreads are narrow, the interest rates blew out, there's a challenge where they would buy XYZ random business at, let's say, 12 times EBITDA, hoping to sort of fix it, hold it, and then sell it for 14 times or 15 times for your sort of middle market or even larger cap or larger deal private equity. Well, a lot of those deals aren't happening because they required low interest rates. So you have too much allocation, and then that makes it hard to sort of, if too much money is out the door, then you don't necessarily have the liquidity to go fund your next fund that comes to you. And so even among those endowments and so on that might want to invest in oil and gas right now, even if they don't have that ESG barrier, they just have a funding issue. And that seems to actually be getting worse, not better right now. And then private credit is just starting to have issues, and some of the private real estate stuff is having real issues. And so if you look across those allocators, so even if they want to give them money, even if they want to back these sort of top performing private equity funds, in some cases they actually can't. And so you're having relatively small funds, and those funds are in most cases actually already allocated fully to the teams that they're already committed to supporting. So I think it's early stages. All of that is set up really nicely for really high returns on those investments. Frankly, I've been looking at doing some private deals too, just like the potential returns, especially on some of the smaller, less competitive ones, are astronomical. But that sort of environment's great if you have the capital and can deploy it. But I don't think that's sort of going to be the savior of the industry. And then importantly, because that's not happening, you're not seeing these teams come in, buy these non-core assets and drill them up all at once so much. And so that's, I think, suppressing volumes, and the lower the volumes are, the higher the price is going to be.
Yeah, interesting. So one thing I really admire is you're able to break these things down really technically. And you've really thought these things through, but you're also able to bring up the very human side of energy. There've been a number of times where I feel like we've gone deep on like the unfortunate narrative people have about energy and just all kinds of headwinds and misunderstandings that actually risk hurting people. And in the grand scheme of things, I think, you've named it a little bit already. Just where do you think we're at in this sort of narrative of oil and gas bad? We'll replace it with solar power, and kind of these two things, these unrealistic narratives are going to bump into each other either very intensely and have a huge like smashing impact, or they're just going to grind against each other until the truth comes out, the reality of the situation comes out. And I guess for you, where do you think we're at? Like, is this a windshield about to hit a bug, or is it something maybe a little more subtle where people have to look around and say, actually, we do need this energy? And we've had these moments with geopolitical events and things like that, but not nearly to the degree that you would expect. Because I was just curious about your thoughts on that.
Yeah, it's a great question. I think historically, what is it they say that that very little changes in a year, but a lot can change over multiple years, sort of similar to, if you try to do a lot in a day versus, or they say people overestimate what they can accomplish in a short amount of time and underestimate what they can accomplish in a longer amount of time. I think from an energy perspective, the right way to think about it is on a sort of multi-year basis. So in the short term, I mean, as you get tighter from an energy supply perspective and as demand rises, you have more of a risk of something breaking or, something along the lines of what we saw in 2021 and then 2022 with the energy crisis and some of the knock-on effects from that. So there is a risk of that, but I don't know. Those things are hard to predict, and usually they don't play out how you would expect or when you would expect. I think longer term, you're going to see real issues. The amount of investment in exploration and delineation in oil and gas globally is insufficient. And then even where there are discoveries, they're in increasingly unfriendly places or places where there's just no framework for development. And, one of the roadmaps, I think, for that is actually what's happening in uranium right now, where there was a coup in Niger. And there's a mine that should get built that makes all the sense in the world and a super high return, even if uranium prices were to fall a lot from their current price. And you're just not seeing that sort of development go forward. So if you just scooch down a little along the west coast of Africa, you look at some of these giant discoveries that were made recently, which is promising, right? It means, hey, maybe there's going to be less of a shortage for oil. But wait a second, you look at what's happening in Niger, and then you look at the stability of some of these countries, and things actually look pretty promising for South Africa. I think of the recent elections, that was probably the most promising of the recent set. It's an election year globally this year. The Mexican result was very, very disappointing, but the South African result actually looks promising. Even with that, South Africa is massively unstable, and potentially, even if there's a path towards improvement there, it's coming from a very sort of bad place economically and from an infrastructure perspective and so on. And then up the coast, there's just lots of questions and lots of potential issues. And so even the limited amount of activity and the limited amount of positive aspects from an exploration and delineation perspective, at least on the oil side, are sort of, I think there's at least question marks around how effectively will these fields actually be able to be developed? When will oil really be able to get produced from them? What will the fiscal terms be? And then how much will that change in sort of fiscal terms and rule of law affect the ability to actually get the volumes that people hope for or expect? And then even again, you go a little further up the coast, and we have these reminders of the cobalts of the world that had ostensibly these giant discoveries, and they were big, but they were nowhere as big as the sort of early press releases or excitement. And so I think those sorts of disappointments and those sorts of challenges, I think purely I'm taking the energy question and just focusing on the oil aspect. I think we're set up for potential disappointments. And if any of these fields that people are so excited about and hoping for more production from end up being more like Jubilee or something like that, I think we could have really high oil prices, and I think there'll be a lot more questions about how we got to that place.
Interesting. And Jubilee was in Ghana, correct? Was that Ghana?
Was it Angola?
It was. I'm too old. I remember a lot about it.
The point is just, it was supposed to be like a 10 billion barrel discovery, and then it ends up being 500 million barrels or something, or a recoverable resource, which again, normally you don't get to hit all the oil in place, but you might hope if it's amazing rock like they were representing. I mean, their argument was it was similar to Gawar.
Right. Yeah. Big leap there.
Yeah. And the rock looked really good, but there wasn't nearly as much oil there, and it wasn't as recoverable as people thought.
But everybody hopes it could be as abundant and prolific.
Yeah.
Well, yeah. And that, I mean, kind of jumping into just for the listeners on the geopolitics, and I brought up Ghana. Maybe that's why I thought it was there. But so Ghana was a big, from a geopolitical perspective, there's a documentary, I think it's still on Netflix, called Big Men. Have you heard of it? It was about Cosmos Energy's discovery in Ghana. Mm-hmm. And it became sort of this political tool where, nobody thought they had oil, so Cosmos got these concessions for cheap, has a huge discovery, and then lo and behold, it becomes like an electoral thing where it was, hey, your current president sold you out, should have never given it this way this cheaply, and I'm gonna take it all back. And Cosmos not being a huge oil and gas company, what legal recourse do they have, and all these sort of things. And so you immediately see the geopolitics, the tension of the promise of the potential economics, along with the political uncertainty that comes with a sudden find like this, where there's a lot of power structures being rearranged. Anyways, if anybody, is able to find that, I found a quite fascinating documentary.
Let's talk about that for a second. Yeah. So I started my career in management consulting, and right around when I started in, 2005, there was a book that came out called Management Consultant. It was Consulting: How Management Consultants Steal Your Watch to Tell You the Time. And so there's a famous principle, and I hope I don't offend anyone by saying this, but it's called the call girl principle.
Okay.
And it's sort of famous in professional services, particularly in the management consulting business, at least it was 20 years ago. And that principle is very simple. Services are more highly valued before they are rendered. And so that's very true, unfortunately, for exploration or development or delineation or various activities across a variety of industries. I think we're seeing suppressed geopolitical risk and oil price and in oil prospects for two reasons right now. So one is that computers, the trading algorithms trading oil, apparently don't have a mechanism for pricing geopolitical risk. So anytime there's a price improvement in oil because of it, they just sell it because it doesn't fit their sort of comparative inventory models or their sort of shape of curve trading models. I was just listening actually to a podcast from a oil trader for, I think, for Coke, and they also are a professor at, I think, Columbia or something like that. And it was similar to what I'd heard from some other traders. And so now that they've talked about that publicly, it's sort of easy to sort of point to and say, hey, there is this sort of view that oil geopolitical risk is suppressed in the price currently because so far events have not really led to actual price, led to supply compression. Even in 2022, you saw a very brief move up and then that compression again, which I think just reinforced the algorithm selling oil price movements on geopolitical risk heavily. And that's setting up for that sort of 1001 days in the life of a Thanksgiving turkey, where it goes great for those models until it doesn't. And I guess the thought is that they'll hopefully be able to get out on time, which is silly because they're all trading the same signals, it looks like.
Yeah.
But also just, hey, it hasn't happened, so maybe it won't happen. So that's one aspect. But there's another aspect. I think that people don't appreciate how lucky they have it in many places in the world right now. And we see that in sort of different manifestations. One way from an oil perspective is that the biggest discoveries in the last, let's say, 7 years that are coming on production are in Guyana. And I just don't think people appreciate just how wonderful the government of Guyana is, as well as, and they're not paying me to say this or whatever, to be clear, no relationship. I might have exposure to some stuff there, but I could say whatever, and I have, about companies I own or don't. Like, I'm pretty open. And, it's one of those things where people in Guyana and some of the politicians that are in power, as well as that are in the opposition party, have talked about how they don't think they have a fair deal and how they want more economics and so on. But the prevailing sentiment, even as production rises and even as the Exxons and Hesses, soon to be Chevrons and so on, make enormous amounts of money, and soon will have made even more money. And the Hess family will have made billions of dollars off this, and their shareholders will have made tens of billions of dollars off this. I think the sentiment for the most part has been from Guyana, hey, like, we want our share, but we're happy that you're making all this money too. And that's very unusual. And I don't think that's the right way to expect countries to respond to discoveries, especially in Western Africa, especially in Eastern South America and various other places. So I think we're sort of sleepwalking on geopolitical risk, partly because of just how wonderful the Guyana government has navigated things so far. And again, if anything, I actually think the companies that are active there are maybe pushing things a little too hard, where they're doing things the government says, hey, don't do this. And it's not a legal thing and it's not really affecting stuff. But like, if they want you to cap out at a certain percentage of the market, you don't really try to go buy more than that. And that's fine, right? In the US, we have those sorts of FTC controls that it's a reasonable thing for a government to want to have multiple suppliers of whatever in any kind of producers or, or distributors of a product or service. Wanting competition and aggressively promoting it is just, it's perceived as a common government right across the world. And so, even with that, even with sort of this really aggressive behavior by some of the companies that are active there, they've still, from what I can tell, behaved really well. Why that matters is I think that's maybe the exception and not the rule. And we've seen even countries that ostensibly have rule of law and property rights, like the UK, just go absolutely radical in terms of just expropriation of oil assets. I'm surprised there haven't been more lawsuits and stuff on the almost 100% tax that they imposed in the North Sea. So anyway, that's a warning, a reminder. And, I think some of these other discoveries that people are excited about are substantially at risk. And I think the model for it is more Niger, which frankly, they'll probably build that mine, but there's a lot of political instability and a lot of risk on a lot of this stuff. And any aspect of that getting manifested pushes production timelines way off and could send oil prices radically higher versus people's expectations.
Yeah, I think it's an interesting thing to think about. I think everybody sort of scratched their head when they look at volatility of the past relative to the awkward silence that we see now when events happen. And, I'd thought about this as well, where it's like a lot of it is, oh, well, OPEC could just open up the spigots. It's like, well, that's all in one geographic area, frankly, and one that has a lot of stuff going on right now. And so I think that there's also a bit of a misnomer that, like shale has been great because it's sort of buffered against a lot of this stuff. And it's in, a lot of Texas and state land, or private land. It's easy to produce, easy to get a pipeline in, easy to, develop all these things with few interruptions, where the rest of the world isn't like that. And as you've mentioned, either activity is going to have to pick up in shale to buffer against these things, or you're going to have to hope for very peaceful times in the areas that can actually, cover an event shortage.
Well, so there's a couple of things in there. One, I think there still is the question of OPEC having the capacity they claim. Mm-hmm. And, there have been excellent books and articles and so on written about it. We've written on it, but, we stood on the shoulders of Matt Simmons and others that have done the real work on it. We just looked at their work and said, hey, here's the math. Here's like 3 ways to tell that they probably can't produce what they say. Or I like how Arjun puts it, the former head of Goldman Sachs energy research, now at Veriton. He puts it that, hey, the Saudis have never produced more than 10 million barrels a day sustainably. So why should you give them credit for the ability to do that? I think that's sort of a very reasonable sort of baseline. Like, hey, if you say you can dunk, but you've never jumped more than 8 feet, why should we assume that you can jump and dunk a 12-foot basket?
Right. And when you're doing analysis and that sort of thing, people can be very optimistic about certain things or whatever, where you have to say, okay, well, what does history tell me relative to their own expectations?
So and on that point, the other aspect that I think people are just absolutely asleep on, and I really think that the EIA stopping this DPR report it should be like a 3-alarm fire, right? We have oil stocks, as we're talking about it, down massively month to date, down massively this week, down today, despite this news. And shale production per the EIA is around where it was in October of last year. So per the EIA, and I think that number might actually be a little high by a couple 100,000 barrels a day, maybe 300,000 barrels a day. Per the EIA, there hasn't been shale growth in 9 months, 10 months. So 8 months. I mean, it's pretty remarkable. So if we're supposed to have 400,000 barrels a day of growth this year, when? And from what rigs and what completion crews and from which wells? And then where are we going to see lower decline rates, not higher decline rates like we're seeing right now across various shale fields and so on? And then where are we supposed to get the production growth for shale next year if we don't have many more rigs? And if the IEA is out there telling everyone that demand for oil is going to peak in 2029, I think it was even like liquids. It wasn't just oil. It was oil and natural gas liquids. Why would anyone add rigs, especially if they have limited drilling inventory? Maybe they'd rather just listen to the IEA and reduce their rigs instead of increase them. And if the IEA is wrong on their demand forecasts, which they've been wrong on almost all of them in over a decade.
It's a running joke, really.
Yeah. I mean, look, like there was COVID, but that wasn't a structural demand issue. That was an event-driven demand issue. And aside from that, they've been wrong persistently for over a decade. So that would make me think that you're having this supply compression and pressure to really reduce your incremental supply. We're not seeing that incremental supply from shale. We are seeing some from Guyana, but that's mostly just offsetting production elsewhere. And we're seeing demand, even on the low end, what is it? The consensus is 1.4 million barrels a day of demand growth. And we see right now, I think it's about 1 million barrels a day more than last year. And that's with China very weak, India very weak, at least last month. So, any sort of pickup, any sort of stimulus, any sort of, European economy being less terrible, U.S. economy being less terrible. And there's a lot of demand upside there. And then this incremental source, I think we grew something like 8 million barrels a day of oil production in the US in the last decade from shale. Yeah. And then an additional, 5 or so of NGL production. So, that's almost all of the world's oil production growth in the last decade and a half just from US shale. If that's flatlining or down a little, And if activity is not enough to support current levels of production, if demand grows even 1 million barrels a day, where's it supposed to come from? And where's the supply supposed to come from? And how do you not end up with much higher prices?
Yeah, no, that's interesting. There's one other question I had. One thing that we also seem to hear, or it's a convenient narrative. I want to hear your view on this. Is that election years are just bad for decision making, anyways? There's like a behavioral component, regardless of the fundamentals of like a lot of things don't change regardless of who's in office. Yeah, policy. Some of it's crazy and that's scary, but a lot of it is not as much, or it doesn't survive in court or whatever. But the nature of my question is, there have been a few folks who've alluded to like, well, we don't know how the election's going to go, so we're sort of in a holding pattern, which I think is normal human behavior, but I don't actually know if it's practical economic behavior. What is your take on election year business decisions?
I mean, I think there's always uncertainty and there's always excuses for procrastinating or perseverating. And I think just in election years, there's a convenient excuse for that. So I don't know I don't think it's a unique factor. Obviously, it's they come up, 2 years, 4 years, other countries 5 years, 3 years, whatever. But I don't know that that's the root cause. I think there's a lot of economic uncertainty in the U.S. and globally right now. I think we've gone very far. I put on Twitter, I took sort of a risk and posted something that was sort of more political about how there was the G7 gathering. And it was astonishing because like half of the people weren't even elected. They all talk about how they're like pro-democracy. But, you look at like the UK, the prime minister like was not elected. They sort of forced out the last person he was appointed, and various other sort of similar stories. And then they're all deeply unpopular. Like you can look at their like unfavorable ratings, and that's also, I didn't post that, I don't think, but they're deeply unpopular. They in many cases aren't elected or weren't elected or are unlikely to be reelected. And I think a large part of it is just their gross sort of economic mismanagement. And each country, each political party will blame someone else. It's always, in the US or Europe, they blame China, and China, they'll blame the US and Europe. In Canada, they blame everyone, even though it's really their fault. But it's really an interesting spot, because even as there are elections that have disappointing consequences, like the election in Mexico, which really, really was disappointing. They sort of instantiated this sort of communist party with very scary and very disappointing. But it's hard for many of these countries to get worse. And so given all the elections that are happening, there's actually, I think, a lot of opportunity for things to get a little less bad. And if you had, and the way I would measure that is from just pure like lower regulations and lower taxes and lower trade barriers lead to more economic growth. And that would be sort of good for the global economy, as well as typically for the countries that impose those rules. If you look at Argentina as an example,
Cuppy. So Cuppy's blog, Adventures in Capitalism, he had sort of a thesis on Argentina for those listening, and it was funny because he was basically like, "Look, it's probably not going to get worse. It was in such bad shape that he was like, frankly, the election, like, there's a chance somebody could win who's actually going to do something about this." And his timing or whatever was off a little bit, but his thesis wasn't wrong. I guess timing is everything in markets, but it was just fascinating to see his analysis and see it play out, where the guy gets in and he's like, "I'm cleaning this mess up. Like we need a functional country,
Yeah, I think so. But that's sort of more country specific. And my thought is that if you look globally, there's both these sort of like global leaders, and groups of them are just astonishingly bad. And then the individual country policies are astonishingly bad. And so if you start at a very low baseline with very low expectations, any improvement in any of these countries could end up being really positive from a global perspective.
Yeah, that's a good point.
And then when you think about what happens after this election season, I mean, I think there's a lot of similarities to let's say the year 2000, 2001, 1999 to sort of the current situation, both in terms of tech stocks, as well as the US economy, as well as global economies, the dollar has been strong, and there's various other factors that are sort of at play. Oil and energy prices have been quite low compared to sort of their historical levels. And, there have been lots of sort of global issues. And what you look at as the world emerged from that situation, you saw enormous stimulus, which I don't think is such a great use of taxpayer money, but hey, it works in terms of short to medium term economic activity. And I think there's a possibility we actually see stimulus payments this year pre-election in the US, which I know is sort of like an odd call. But if you look at, it happened in 2008, it happened in prior periods. And the reason to think it might happen in the US is, and again, this is more of a global question, like, hey, what happens, whatever, but we're in the US. So people, I think of the listeners are mostly going to be in the US. And so it's something that they're more familiar with, so they can have a view on. And I'm sure many people will tell me I'm just dumb and wrong for this. And that's fine. I'll take that risk. If you look in 2008, there were large stimulus payments direct to people, and that didn't get Bush, or it didn't get McCain elected. It didn't get sort of a Republican staying in power, despite there being stimulus payments while a Republican was in power. So I think there's some precedent for the opposition party, in this case would be the Republican Party, to approve stimulus payments if they get convinced that the economy is not doing so well. And I think as there's sort of more evidence that the US economy is actually not doing that well, especially for some of the poorest people, I think there's going to be increased political pressure and worse polls for the Democratic sort of ruling party currently in the US to do something about it. And so I think, it's obvious that the ruling party would want to support that. And then the thing that I think is sort of a variant view on my part is that there's a precedent for the opposition party actually winning by being the advocate of that stimulus. And so the ruling party can say, hey, we did it. And the opposition party can say they did it because of us. And so both sides get to win. And the reality is that the consumer wins. And I think what we saw with the financial crisis versus the 2000 election versus COVID is that the most effective way to stimulate the economy was not to give money to banks or insurance companies. Shockingly, it was just to send money to poor people. And so I don't know. I think there's a decent chance that we end up seeing that, which would be enormously bullish for oil. And then it's not unprecedented. And again, whether it happens before the election, whether it happens after, a lot of that's sort of just short-term questions. I think we're going to get into a situation that's stimulative either through direct payments to poor people and maybe to the broader sort of population, or through reduction in regulation and sort of more viable economic policy in at least some of the places that are having elections this year.
Okay, interesting. Wrapping up here, I guess we've been talking for a good bit, and I certainly appreciate your time. But we know you're obviously excited about oil and gas. You're excited about some prospects. Is there any other sort of thing that you are focusing on because it excites you right now?
In terms of markets?
Yeah, markets, you name it.
Yeah, I think you and I were talking about this before we got on camera. I think there's a real question around AI, right? In terms of these data centers and in terms of sort of the potential incremental demand for energy at a point where I think a number of the markets that these will get built out in were considered mature and weren't really orienting towards growth in broader energy demand. I think there was sort of this expectation that there would be electrification in the US and various Western countries, but that it would be electrification shifting from, gasoline powered cars to electric cars and so on, not electrification of growing top line energy demand while also trying to engage in that sort of shift or transition. And so, I think it's going to be really interesting to see how quickly these data centers are built out. And I think it'll be interesting to see how efficient they get, because if they're not super efficient, we could end up in a situation sort of similar to what we saw 2 or 3 years ago, where you could see an extra 1 million barrels a day of oil burn just for backup power generators.
Wow. Yeah. So I've read a few articles about that. I've been watching this too, like the number of proposed data centers, the fact that some of these folks who want to put them in, they're buying the rights directly from nuclear power plants. And they're, oh, we're not the carbon emitters, but they're taking electricity from the market that is going to have to be replaced for residential, what have you. Originally, when we invented something new, we sent it somewhere else to be manufactured, and they released CO2 or whatever, and our electricity production pretty much stayed flat. But the thing with the data center is, especially with all of the legal issues, like this thing's going to have to be domiciled in the US if you're an AI company in the US. And I remember like Virginia has a ton on the list, and they've had politicians saying, oh, this is going to undermine our climate goals. And it's okay, so you're going to turn away all of the, you're going to turn away jobs. I mean, there's not as many with a data center, but like construction jobs, at least, like you're going to turn all that away because you're going to do this holier than thou thing. They're going to get built somewhere. And so, but I just think it's fascinating because it is a U.S. It's a U.S. heavily driven by the U.S. Granted, other countries have been working on AI as well, but like it has to happen here. Unlike a lot of other, an iPhone was considered revolutionary, but they're not made here, right? They could be designed here.
But we're also a low cost of energy geography, right?
Yes.
So we are, there's a lot more regulations in terms of building out data centers, and parts of the US are very expensive real estate wise. Parts are not. But we are a low cost provider. So it's not the same as trying to build a assembly plant for phones, right?
Because it requires all these people and
regulations and lots of issues and expense and so on. You can build a data center and it's actually pretty minimal impact other than the energy aspect. And like you said, if you take away a lot of the base load, you're left with more intermittent. I've looked at, you have a home backup power generaat
which
we have
I've
a small
used
one
repeatedly in the past 2 weeks. So
we have a small one from Costco. We need to get like a real one at our house. And, I think unfortunately there's going to actually be a bigger impetus to use those. And the real sort of supply, the energy supply for those, for the most part, outside of Texas is on the oil side. It's going to be diesel and gasoline and so on, rather than natural gas, just because natural gas supply in other parts of the country is not necessarily as assured as we have it here, given that we're also a large producer of natural gas in Texas and how our pipeline networks and stuff work. And so I think you get really interesting where you have these build outs of solar power and build outs of data centers and very minimal build outs of stable, reliable power, whether it's nuclear or natural gas or coal or so on. I mean, you still have coal power plants going out, getting turned off rather than getting built, at least in the US. And so I think we could be getting into a situation where we get into more of a third world style grid. And then, when you see a lot of these data center proposals, you're starting to see, I think, more of them where they're not even going to go on grid, where they're just going to go, like you were saying, either behind the wall at like a nuclear power supplier, or in many cases, they're going to go and just get their own natural gas supply and, in some cases, pair it with solar, which is fine, right? It sort of makes sense. I mean, there's some issues in terms of the power transformers and the circuitry and so on, but you can solve that. So yeah, I think that's going to be a really interesting trend. It's always interesting to see sort of these new demand centers. And the reality is that with Javon's paradox, right, as we get more efficient, we just use more energy. And so these sort of Malthusian forecasts, like the IEA forecast, I think it's very comfortable betting against those. And whether it's AI, whether it's just, people, the 7 billion people in the world that don't use as much energy as the fortunate 1 billion, I think there's room for a lot more energy consumption. And I think we're not doing enough. We're trying, but we're not doing enough as an industry to provide for that capacity for when it gets called on. And so I think eventually we end up with much higher oil prices and potentially much higher natural gas prices too.
Okay, and that means a lot of folks busy in the field working, and us in the office, hopefully making it happen as efficiently as possible.
Yep.
Well, Josh, I just want to thank you for your time joining us. It's always exciting to have you, just because you bring a different take. A lot of times we're talking about very technical things, but a lot of our folks are curious about just what's going on. Like, it's great that you're talking about fluids, but at the same time, like I'm really curious about what the market says. And so it's really helpful when somebody can shed light on it like you can. And if people wanted to follow you, what is the best way to kind of keep up to speed with your sort of investment thesis or things you're watching? Where is X probably the best place to do that?
Yeah, you can find us at bisoninterest.com or on Twitter, X, whatever it's called now. Find at Bison Interests, or you can follow me, just search for Josh Young and you can find me. And, same for you. I like listening to your podcast. I get to learn some stuff that I wouldn't have learned and maybe can't always use. But, it's really helpful, I find, to get to meet people. And actually, a number of the people that you've interviewed, I've gotten to meet and gotten to chat with. And it's really helpful to learn about what's coming from an oil field perspective. So that way there's not sort of the same sort of broadside. I'd say I was pretty surprised in 2014 when shale productivity ramped the way it did. And so staying on top of some of the technical trends and some of the changes from a field perspective are really helpful for me. And I think for others that listen to your stuff too.
Well, we'll be sure to grill some meat together again soon. I know that's something we can count, that and maybe a bottle of scotch, but thanks for your friendship. Thanks for coming on. And listeners, if you do have questions for Josh, you can reach out to him through that format. If you have any questions for us at the Flowline, you can reach us at the Flowline podcast at aesfluids.com. Please share this episode, like it, tell your friends. And with that, we'll say goodbye. Thanks.
Thank you.
Thanks for listening. Please tune in next week for another exciting episode of the Flowline. And remember, may your returns always be full and your trips always smooth. Views expressed in this program belong to participants and not their employees. The program is for informational purposes only and cannot take the place of seeking professional advice. Copyright AES Drilling Fluids.